We're going to talk a little bit about stock repair, not just what the stock repair is, but what to do with a stock repair position if it goes one direction or the other. And we're going to talk about evaluating criteria on a single stock, how to evaluate criteria if I'm looking in the search tool or I'm looking in a given standard tool and my stock doesn't come up. I put it into the symbol lookup field, it still doesn't come up. How can I quickly evaluate why it's not coming up as well? But let's start from the top. From Dennis. Dennis called, actually talked to Ernie today for a little bit. I was on a coaching session, I believe. But he says, I have more than once found myself doing a ratio spread stock repair. Stock repair is a tool we have on Power Options. Don't worry, we're going to walk through that in just a moment. On a stock that I don't mind owning. Also, more than once, the stock has recovered quicker than I anticipated, and I find myself needing to hold to expiration to get back to break even or a small profit, even though the stock has recovered completely. Because the recovery was quick, the ratio spread actually hurts the outcome. Of course, you don't know that when you put it on, and you're not expecting it to come right back. I'm curious if there are adjustment strategies that might be viable during the life of the repair that might mitigate this situation, either allowing for more profit or less time in the trade. Now, on a continuation of this, as example, on May 29th, we bought 300 shares of BAH at 154.10. Earnings came out on 7/26 and the stock reacts poorly. It gaps down to 140. Not too big of a drop. I've actually had two stocks in this cycle when married put positions. One was bulletproof, one was not. But they beat earnings, they beat estimations, but they lowered their future guidance, and both stocks dropped about 14 or 15%. So I'm with you on that, but this isn't that big of a drop. That's okay. So the stock's still laboring down in this low range. On the 14th of August, we had a ratio call spread from the stock repair tool. Don't worry, we'll walk through this. We'll see the math on it, but we buy 3 September 145 calls at 576 and sell twice as many, 6 calls at the 150 strike for 298. Well, that gives us a small net credit. Of course, we're up to about 596 with the total credit from the 6 calls sold. So we get about a 20-cent net credit. If the stock was trading at 150, we'd be back to break even though the initial purchase price was 154.10. We'll show how that works a little bit in a moment. But now the stock has recovered quickly. It is above the original purchase price. We're way above 154.10, which is way above the 150 call strike that we sold. However, the entire position is still at a loss due to the added ratio spread. It's at a loss because we need the rest of that time decay to September expiration to see the full profit that Dennis is referring to. Now, of course, he says if it holds to expiration, meets the need, but I have the risk until expiration. Any thoughts on how he might be managed differently after the ratio spread was implemented? All right. Well, first off, what is the stock repair? Well, as you can tell, it's a call ratio spread. We're going to buy a lower call equal to the number of shares that we own, and we're going to sell 2 higher strike calls to receive a credit. Essentially, what this does is it creates a covered call position. Half of the sold calls are protected or covered by the stock that we own, and the remaining, in Dennis's case, 3 calls that were bought at 145 and the remaining 3 calls that were sold at 150, it's a bull call debit spread. In these situations, I tend to treat those 3 calls at the 150 strike that you have against the stock essentially as just a covered call position. And I'm going to look to roll it as I would a regular covered call that now went in the money that I did not want to be assigned, using the PowerOptions Portfolio tools and linking to that position analysis screen to see what roll opportunities are there for an in-the-money covered call that I don't want to be assigned. What I want to do first is take a look at one of my positions. I have 4 married puts open right now: MMYT, PSTG, Trex, and Urban. And although Urban is really low, Trex and PSTG were the ones that were recently hurt by earnings, PSTG the most. But I want to take a look at that. So let's go over here. We're going to navigate over to the chart of PSTG. Now, when I opened the position, the stock was about at $59 per share. So it was way back here. I was actually before this. It was right around this time here, I think, when I started to see the Bollinger Band break. I'm sorry, the MACD breakout. We started to move up. We were able to do some income methods, got some trouble, so on and so forth. Done some different income methods. We had a drop here. It started to recover, adjusted the put, got a lower risk on the position. It's out to March of 2025, I believe now, anyway. But then, of course, earnings hit, and now the stock we see is trading roughly at 51.50. Let's just call it 51.50, the old rail. It's 51.29. Okay, so it's 51.29. Now, what is the stock repair tool? I'm going to navigate back over to Power Options. I'm going to put in my stock symbol of PSTG, and I'm going to click on stock repair over here on the links next to here. I could also navigate it through our signature tools, long option finder, stock repair, stock insurance tool, other tools, volatility skew, strike of pain, and more. But we're going to go to the stock repair tool. Now, this tool is pretty simple. As Dennis did, I have my stock PSTG. We're going to put in my cost basis, don't need the dollar sign there, but we're going to put in my cost basis of $59.50 roughly. And I'm just going to put in 100 shares to keep the example simple. Now let's go ahead and submit that. Now, okay, so I have some repairs available for PSTG right now. Thankfully, this isn't a married put, so I think I only have a 2%, 3% risk on this position after the adjustments I've done, even with that recent 14, 15% decline on the trade. But I do have a repair. Remember, the stock's at 51.29. What this basic view, is showing me is that I could have a stock repair by buying 150 strike call and selling 255 strike calls for December, and I'll receive a net credit of $1. And my new break even is now 54.25 at December expiration. Well, how is that possible? I only got $1 net credit. I bought the stock at 59.50. So my cost basis only drops down to 58.50. How does this work? How is my break even 54.25? Let's take a look. So I'll go to repair details first. And this gives me a breakdown of what's going to happen. I have 100 shares of PSTG, cost basis of $59.50 with a stock at $51.29. Currently have about a $800 loss on the stock, $820. I can buy one December 50 call on PSTG for $6 and sell two December 55 calls at $3.50. So I'll get $700 in credit. Now, there's the $1 net credit that we saw. That's only going to reduce my cost basis down to $58.50. But what happens at $54.25? Why is my break even $54.25? I'd have a $5.25 loss on the stock from our purchase price of $59.50. I took in $1 net credit. I bought a 50 call and sold two 55s. So at $54.25 at December expiration, my 50 straight call is going to be worth $4.25. $4.25 plus the $1 net credit counters the $5.25 loss, and I am at break even for $59.50. Still about 10% away from my original purchase price, but now I'm back to break even. Okay, so that's what it's looking at mathematically. Let's look at it graphically. Okay, so then I click Analyze Trade. Here's my position, 100 shares of PSTG at $59.50, buying one December 50 call at $6, selling two December 55 calls at $3.50. Again, paying out $600, getting $700 back. That's our $1 net credit. Our new total cost is $5,850. At December expiration, again, if the stock's trading at 54.25, our long call's worth $4.25. We sell to close that call. The 55s expire worthless, and we're at break even. If the stock goes to 55, well, we make 2.6% on a position that's down almost 14% right now, from $59.50 down to $51. All right, so that's the power of the stock repair. But in Dennis's situation, what happens if my stock goes to 58, goes to 60, goes to 62? It happens 10 days from now, 15 days from now. You see the red line on our profit and loss chart is at the halfway point on October 28th. In Dennis's situation, he got there at about the same time period. It was about a month later, half a month. I'm sorry, Dennis, 8/14 when you open the repair to here. So that's what we're looking at here. This is what he's seeing, because when you get to expiration, you lose all the time value on the two sold calls. You've got intrinsic value on the long. The hockey stick graph is at expiration. But here we're still at a loss. Not as big as a loss if we had done nothing, right? If we had done nothing, of course, the stock came back up, you'd be at a break even. I'm sorry, I said that wrong. If you did nothing, of course, right now, you'd be at the correct price. You'd be at break even and a little higher. But now, because we still have time value remaining on the short options, we have time value remaining on the long option, but since it's deeper in the money, it's a little bit less. Now, let's take a look at Dennis's position now that we've discussed all of that. We're going to navigate over to the portfolio tools. And here you see I've entered his position. Booz Allen Hamilton, BAH, 154.10. I purchased at 612, Dennis, just because that's accidentally when I set the portfolio date to, so that's fine. But it's just about the math. It's not about the dates. And then I put 726 instead of 814 when the earnings fell. That's okay. We bought 3 145 calls at 576. We sold twice as many calls, 6 calls of BAH at 298. We got that small net credit, as you mentioned, of about 20 cents. The stock's now at 158.78. So he's actually at a $4.68 profit from when he got into the position because it recovered so quickly, as you mentioned. The calls that he originally bought have gone up $2,600 from 576 to 1445. So we're not quite at intrinsic value. 145, 1445, that would put us at 159.45. So you got about 70 cents of time value, roughly, on the long calls. But the short calls are at 9.35. They're $8.78 in the money. So we're still about 60 cents or so of time premium times 2 at 120, but they've gone up 38.22. Now, right now, according to my numbers at midpoint, Dennis, you're at break even. Better than a loss, but you would have just had a profit, I understand. But now we're in this position, okay? All right. So, what do we do now? As I mentioned, what did we do back in that original position? I have 300 shares. I bought 3 calls, and I sold 6 calls. Essentially, what I did is created a covered call position where 3 of my short calls are covered by the 300 shares of stock. And the remaining positions of 3 contracts of the long and 3 contracts of the short is a bull call debit spread. So Dennis, what I tend to do in these situations, I will track it here so I can see the total gain and loss in my portfolio as the ratio call spread that you entered, as the stock repair. But since you can create as many portfolios as you want at PowerOptions, I'm also going to track it in a different portfolio as just the covered call, 300 shares of BAH at 154.10. Sold 3 calls against it on 814, but I put 726 for 298, so that gives me $894. I'm on a loss on that covered call of 1.1%. Then I'm going to enter the bull call debit spread. I'm buying 3 calls at 145. That was the long portion of our stock repair. And half of the sold calls against that creates the bull call debit spread, where I entered in for a debit of 834. And right now I can liquidate it for a profit of 696. So here's where you're seeing just the small gain. You've got a loss of 507 on the covered call and 696 on the bull call debit spread. A gain, I'm sorry, of 696 on the bull call debit spread with a max of 1,500. That's the most you can make at expiration if the stock remains above 150. This is also income method number 5. For those of you that own the blueprint, of course, the ratio call spread would be a similar structure. And I track this the same way. Occasionally I use income method number 5. I'll track it in my married put portfolio as the married put with the income method number 5. It will appear as a custom spread. But in a separate portfolio, I'm tracking it as a married put with 3 sold calls against it and a bull call debit spread separately so that I can see the gain on the bull call debit and how that short call is affecting me now that it's in the money. Of course, as you know, as you're tracking any position in the PowerOptions Portfolio tools, we can link directly from this tool to position actions and go to position analysis. So Dennis, as I'm doing this and I've separated this out in that secondary portfolio, I want to go to position analysis. This gives me a breakdown of my current covered call. It's at a loss because the stock had dropped. We sold the 3 of the 150 calls, at a lower price. It didn't get us back to break even. That's not the whole position. But in this situation now, hey, I'm losing money on the repair because the stock fell so much and now it's recovered. How am I going to treat this? I'm going to treat this just as I would a covered call on a stock that I own where I sold a call but I don't want to be assigned and now it's going in the money. And as I scroll down, okay, so you have a loss here. The original expected return was a loss. I have a loss of 1.1%. We saw that in the portfolio in the covered call analysis view. In expiration, I'm losing still 0.7% on just this portion. If I break it out as a covered call and a bull call debit spread, how can I turn this into a profit? I scroll down. And of course, stock's at 158.78. So I see opportunities where I can turn my negative loss that we have right now of 0.7% if I let it be assigned into profits, rolling up to the October 150 call, rolling up to the October 155 call. Not quite out of the money yet. The closest one to being out of the money, and by the way, BAH has a limited number of expirations. It only offers monthly. There's only 4 expiration series available. But the 160 strike here is interesting enough. It's 112 days out. But at the same time, I can buy back this call for $9.35. We took in $2.98. I'm going to collect $8.80 here, so I have a new credit on this covered call at 160 strike of $2.43. And I could have a 1.6% positive return if assigned if the stock's above 160. Keep in mind, that's just for the covered call portion. You're still going to make the full, at this point, 5 points back on the debit spread that you entered for a credit. That bull call debit spread with the 145 and 150 strike. So it's a debate here. Could I go with the 155 to October and turn it into a positive only 0.7, then add in the debit spread profit? Potentially, and then still just treat it as a standard covered call. Or do I want to go out further? In my opinion, now it's twofold. In my opinion, Dennis, I'm likely leaning more to this December series. But I actually like this October series where even if I got assigned at 160, I'd be at a loss at 192. Why am I comfortable with that? Because remember, you already took in $1 net credit on the position from the ratio call spread. Technically, your share price is 153.10, not 154.10. That's already been pocketed. But at the same time, the max you can make, profit-wise, is $600. I didn't even realize that, but it's $666 at expiration for the debit spread. So this here, this rolling up to this October 160 call that's out of the money, even though it shows a loss of 192, is actually only a loss of 92 because of the dollar you took in, and you have the potential to make $660. Let's just call it that before I say 666 again, even though I just said it. And that would put you at a profit of about 566. But remember, that bull call debit spread expires in September. You can pocket that additional $5 capital at that point, even though you're looking at a negative assignment here, but you're keeping it shorter term. Why am I suggesting that? Because in 21 days, you're then going to see the November series, the December series, and you have the follow-up probably February or January series that would come up as well after September expiration. So going to October now, even though you're still looking at a potential negative return if assigned, it's not negative due to the dollar credit we took in that's not accounted for here yet on this, and the $6.60 some odd cents we might make with the bull call debit spread as long as it stays above 150. This would be a profit on your position, and then you would just treat it as a normal covered call. But in 21 days between now and September expiration, if the stock goes up to 162, 163, going out to October seems long, but then you'll have opportunities after September. You'll see November series, you'll see January series. In addition to the December, you'll have more roll opportunities to continue the position as a covered call, stay in the stock, and make more potential profit. Let me jot this down real quick. October expiration. I'm showing an October 160 call. Well, let's do it this way. It'd be easier to do it this way. It's great to see things numerically, as I always say. It's better to see them graphically. So as I find a rollout opportunity for my position, let's go to simulate trade. Here's the before and after picture of my current just covered call. Okay. The max profit assigned at 160 is 11.94. In this case, that's that small profit we saw of the 1.6, 1.2% return. But now, remember, cost basis is not 154.10. We're also going to take in the $100 net credit, which you've already pocketed against the stock position. And we could make $667, let's just do it that way, profit on the bull call debit spread a month before the October expiration. If the stock stays above 150, 21 days from now, you get the full 5 points back. Remember, you received this at a credit. So that debit spread, that full $5 is now back to yours. Okay. Why is it 667? Because we're talking about 3 contracts. Okay. It wasn't just 1 contract. It was 3 contracts. So that's an additional $767 roughly of profit on your position, 675, 766, in addition to the assignment return here after the rollout on that position. But you don't have to stay there. If the stock keeps creeping up, hey, September bull call debit spread is looking better and better. I can probably close it sooner for near 90, 85% of the profit. And I can then reduce my stock basis in my position if I do that to account for that position. And I'm going to be at a higher profit. That's another thing to mention now, Dennis, as well. You're looking at a small loss on the position. I get it. But let's go back to that other portfolio. Not necessarily, I think you should deal with the short call first. But if I did a partial close on this position and I closed, I'm sorry, I should have stayed with the other one. My apologies, folks. If I close this one now, my liquidation profit right now is $696. That's going to lower the cost basis of my position. I took in $1 net credit. I could lower this down, adjust this position, show 153.10. And if I liquidated this position right now, I think this is a midpoint bid-ask spread glitch, by the way, so it's probably not going to be 696, probably going to be closer to 640 or 650. But that's fine. What does that do? That also lowers the 300 shares down, so it's another $2 roughly. So if we're talking 3 contracts here, so that'd be $2, let's say, and 20 cents. Let's say it's $2.40, Dennis. So that would lower your cost basis down another $2.40. So we were $153.10 from the dollar net credit you received. Now we're at 152.10. How would that position analysis look to roll this 150 call at that point? Okay, so that's another thing to consider. But again, what I do in these situations, same thing I do with the income method number 5, excuse me, in the blueprint. When I do a ratio spread against the married put, I track them separately and I treat it just as a collar position with an extra bull call debit spread, so I can evaluate the 2 legs separately. Then I'm going to use the position actions and position analysis to evaluate my rollout opportunities that I could use just on the covered call portion, and I'm going to leave the bull call debit spread alone to try to get it to full profit. If the stock starts to turn again, I see some trending changes in MACD or other technicals I look for, then I'm likely going to maybe close the bull call debit spread for 50, 55, 60% profit. Take that into account on the whole position and use that for my evaluation of rolling the calls. One other thing, we're gonna go back to the main screen here. If you have any follow-up questions, Dennis, or anything along those lines, let me know. One more thing I want to do real quick is just go back. Actually, no, you're pretty good on it. You waited, so I liked it. Pure Storage here. Why I'm bringing this up is a couple of the Fusion subscribers asked me, hey, Mike, your PSTG positions just dropped down 14%. What are you going to do? Well, just like you did, Dennis, I'm going to wait. I never overreact. I never knee-jerk reaction to an earnings report, even though it beat expectations, it beat revenue, it beat all that, but oh, now we're going to lower our annual forecast because we see some troubles ahead, and here we are down 14%. But just like BAH, 2 or 3 days from now, this stock's back up to 58, 59, where I originally bought the stock. I'm actually holding, I think, a 70 strike put on this trade. Well, that's going to give me better opportunities to make adjustments. You said it fell on 726. You waited to 814. I like that. That's my approach too. I want to wait. Don't panic. Don't try to over adjust right away. Wait to see what happens next. Give it a few days. Give it some time. See what the stock's telling you after this reaction. And BAH showed you drop down to 140. Okay, not that bad, about a 7-8% drop. And now it's right back up to where it was. But again, tracking the position in the portfolio tool as the standard position that you have. So you can see that liquidation value and the ratio spread. That's good. We're where we should be at break even, max 2.7% return if we're at expiration in that case and the stock's above 150. But right now, we're at just break even. But then what analysis do I have if I track the positions separately in the individual legs as just the covered call and the bull call debit spread? You can see how this is working to your advantage and how you can take advantage of it again going forward, linking the position actions and position analysis, treating it that half of those sold calls just as a covered call trade, and then evaluating the bull call debit spread on it later. So that's where we have for Dennis. And Dennis says, that's fantastic. Thank you very much. Great ideas. I have the blueprint, but tracking the positions two separate is an aha moment.